Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, markets are digesting a flood of catalysts after the Fed, fresh inflation data, and a split verdict on spending. Microsoft's results impressing investors, while Meta's not so much. WisdomTree's Jeff Weniger are going to join us soon, break down whether investors are becoming less forgiving, why higher bond yields could reshape the outlook for stocks, and what Apple and Amazon need to deliver tonight, and of course the market signals he's going to be watching in the weeks ahead. It's a lot, it is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour to the trading day, a strong bounce back for stocks after yesterday afternoon's swoon. What a dramatic session it was coming out of the Fed. So we do have some economic data to get through before we get to the earnings. We got a lot. The U.S. economy actually slowed to 1.5% growth, an annualized rate for the second quarter. Interesting though, beneath the surface, consumer spending strong, business investments strong. It was a drop in net exports. Maybe the market's looking through that. We also got PCE, the preferred gauge of inflation for the Fed. It actually went down a tick month over month, but at an annual pace, it's still at 3.3%, higher than they'd like to see it. And of course, we have earnings as well. Let's jump into the heat map. I don't even need to show you individual charts. These two names are going to stand out for us. We are talking about Microsoft, higher on growth in its cloud business. That's all about AI spend. So this is an instance where the market rewards it. The semiconductors are now rallying as a result, but Meta Platforms, check out those shares, down right now, issuing soft revenue forecast, a 91% drop in second quarter free cash flow. These used to be free cash flow machines. The AI spending is strong, it is real, and it's definitely leading to a bit of a split decision in terms of where Meta is and where Microsoft is. And that's your market update. Well, joining me now is my colleague here in a meeting from our direct investing educational team, and Jeff Weniger. He is the head of equity strategy at WisdomTree. Gentlemen, thanks for being here, and great to have you in the studio with us.
My pleasure.
All right, before we dive into the conversation, we have a lot to talk about. Just a reminder to our viewers that the views and forecasts expressed are solely those of Jeff and his team at WisdomTree, and based on their research. Jeff, so many places we could start. I want to go back to yesterday afternoon. What a wild afternoon in the markets in terms of how the markets initially welcomed the decision, and then the bond market decided it had a different take on it. Equities start to sell off, a bounce back today. My head is still swimming. Let's start with the bond market. What is the bond market trying to tell us about what they heard yesterday afternoon?
I mean, I guess my head is still spinning too. I mean, we all are. I mean, we're thinking about, 19-year highs there on the long bond, the U.S. long bond, something like 520, 522, something like that in this morning's tape. And look, in the last couple of years, generally these round numbers in fixed income yields, whether it's a 10-year T-note or whether it's the long bond, something like a threat of a 5 or a piercing of 5. There have been times where the S&P 500 has decided to sell off in reaction to that. You have this situation where we do have Kevin Warsh was brought in ostensibly to be the person that was going to be dovish, and yet we're all of us, attempting to figure out when he will act hawkishly. And there's something like a 60% probability of a hike now at the September meeting. I don't know if it'll actually come through. I mean, the reality is we don't yet have in the United States the July data, PCE, CPI. Obviously, that stuff will get printed in August. But we did ever so slightly have this tapering down in inflation numbers in the June data. Reason being, we had a crude oil price plunging in the month of June. The problem is when you start pulling up these WTI or Brent charts, right around June 29th, 30th, July 1st, that's when it started to bottom. Mm-hmm. And now we're in big, 15 points higher on Brent, something like that since then. And so that's going to be a real problem for society and for a market that is reliant on a Federal Reserve not hiking policy rates.
Is that what the bond market is seeing a little more clearly than the equity market today, because they're just excited about other things? I'm looking at the U.S. 10-year. It's moving. It jumped yesterday afternoon. It's moving higher. You go further up the curve, the 30-year, they're talking about the 19-year high. Is this really going to challenge equities going forward, notwithstanding today's bump?
And it could. I mean, there's a lot of talk about real yields and nominal yields being higher. You guys know, you've been around the business for a while. The market will decide what it wants to get focused on. And right now, bond yields that's that thing, right? We've made these transitions into whatever is the focal point of the year, and it's the AI CapEx expenditures, it's the Strait of Hormuz, and it's the filtering through on those two things, one inflationary, one deflationary, and how those are going to affect fixed income yields, and then in so doing, cost of capital, right? If I have to operate a business and I need to take either a floating rate obligation, which tends to be a small cap, it's a bank loan, and now I have Kevin Warsh being the next Paul Volcker. I don't think that's going to happen. That's problematic for my small business. And if I have a large business, now I'm coming in with fixed capital, which is going to be something like a treasury plus a spread, and now those treasury yields are higher. So in terms of operating a business, it is a de facto tightening of policy by the bond market, not necessarily by Warsh or Christine Lagarde.
They'll do the job for them, right?
That will oftentimes happen. I mean, think about through the years. I mean, all right, if you think about the bull market, March of 2009, really nothing other than you had the slowdown in 2016. China was going to go into recession, didn't go into recession. You had the summer of 2011 when Greece was going to really implode. I mean, 15 years ago now, when Greece potentially imploding, they got their act together. COVID crash, the 2022 bear. Generally speaking, 17 years of a bull trend. And a good chunk of that was on a 10-year T-note in the U.S. was what it would bottom at 0.6. Right? And you're 400 over that now at, what's the 10-year T-note now? 465?
I think we're sitting something around 465.
Got on my screen right here.
It goes 470 at the bid.
4.66 right now on my screen.
4.66.
So think about it, it's 400 basis points higher than it once was. And so it's not the end of the world, but it is cause for consternation, I'd say.
Yeah. So Jeff, then adding to the wild day we had yesterday and a bit more wildfire, obviously we had the two big mega caps come out yesterday with earnings, Microsoft and Meta. Very divergent in terms of what the reports had. Microsoft had beat on both top line, bottom line. Meta fell roughly about 10%, all around the CapEx. And to the point we raised earlier, Meta's CapEx nearly doubled to 31 billion. Free cash flow is down to 800 million now, just under shy of that. So one of these AI bets got a gold star, the other one got sent to the principal's office. So is the market officially now splitting the AI show me the money stocks, in this case Microsoft, versus the just trust me stocks now that we have?
I like it. And let's go with yes. I want to say that in the reaction, we had Microsoft up 9 and Meta down 9.
Yeah, close around that there.
1,800 basis points of a gap between those two names, which theoretically should be oscillating together because the trillions of dollars in tracker funds on the Russell 1 and the S&P 500, that type of thing. But in the discourse, right, in Bloomberg, the Journal, whatever the case may be, this is never mentioned. But now 2026 rolls around. Now it's all about free cash flow, which is what it should be about. And if you
back to basics, basically.
Yeah.
Back to
basics.
Fundamental valuations. And look, Meta has to prove itself at this point. Maybe Microsoft is doing just that.
Yeah. Well, and today is obviously going to be another test because we've got Apple and Amazon coming out of earnings today. And so what would you like to see now is we said we're going back to basics, fundamentals. Is it still going to be the story that, and Amazon's probably one of the biggest CapEx spenders out of the group. I think they're north of about 200 billion, I think is what their number sits at. So what would you like to see on the report card for these two coming out tonight?
Okay, when you're talking about poster children of the Mag 7, are we still going to use the term Mag 7? Because now there's probably 15 companies in there.
In the $1 trillion club, yeah.
Yeah, we could throw the two Korean
so much magnificence out there. So much magnificence.
The magnificent. So if you think about the magnificent question mark, magnificent 7, 10, 15, these various ideas, Amazon is the poster child for free cash flow question marks 2026, 2027. There's another little side, so maybe they'll get punished. We'll see how it ends up coming out if they're doing red ink on that front. The other thing that's intriguing about all of this is when we think of Amazon, and when I say we, I mean me. It's Amazon Web Services, and then it's the retail side. And to me, and my guess is to 99% of viewers, that's the business model of Amazon. But now it almost wants to be getting into telecom and compete against Starlink. It wants to put these satellites up there. So now is Amazon going to compete with Elon Musk now? And this is one of those concepts that I think in the Mag question mark, mag 7, mag 15, whatever the number is we oftentimes think of these, we call them hyperscalers, we have all these terms that we use, and that they're all going to necessarily have monopoly profits or be dynamos in 2029, 2030. And then you start scratching your head and say, across various business lines, A is competing directly with B.
They all want to be in each other's businesses now.
Yes.
I just can't be an
And
e-commerce
they're all
giant. I
funding
need to
each
be
other at the same time
And,
too.
well, then
Let's not
that's-
get into that.
Well, that's the other concept, and, and we saw that. I'm trying to think. Anthropic did that circular funding the other day with, was it AMD?
AMD.
And
yeah.
so, but that's another one that's in the mix. AMD is in this, and so you have 7 or 8 either chip, in some way, shape, or form, chip names with the hyperscalers, and then now the hyperscalers are going to make chips. So it's an interesting market. It's a market that's massively top heavy with some of these names, and I'm fascinated with it because I'm a stock market geek. But it's even to the point where when you run large cap screens and you end up, it doesn't pick up XYZ Corp, fill in the blank, Alphabet, Amazon. You end up almost drifting down into mid cap or mid/large, even if you have a large cap basket.
Let's get into that, because now you're starting talking about broadening out just beyond, as fascinating as the tech trade is.
Yes.
And there will be some days where I'll say, wow, healthcare is getting a really strong bid. Consumer stocks, maybe the rotation is happening, maybe the broadening is happening, and then everyone just rushes back into the tech trade. Is this truly a market that's starting to broaden out as you talk about going into those other names?
Well, look, small caps are in rude health. Small caps have been having a very good year, generally speaking, certainly in U.S. equities, global equities in general. If you think about the sector work inside the market, what did we see Jamie Dimon say 10, 15 days ago? It might be bearish, we'll see. It's as good as it gets for JP Morgan, which by proxy is as good as it gets for Morgan Stanley, B of A, and so forth, because you have pretty decent, dare I say, robust M&A environment. You have trading volumes because everything's Brent crude price, and we had this big up and down, basically 3 big moves here in stocks this year. You have a credit environment, which is certainly stable. And part of that's also, this goes back to, if you're thinking about financials, the financial system, other sectors rising in prominence, because if I'm not mistaken, we'll have to check the chart. Something like the XLF, competitor fund, is at 52-week highs or darn close to it.
Our Canadian banks have just been on fire for the past year. Yeah.
Canadian banks at up and to the right at a 45-degree angle.
Yeah.
And there's a lot of charts out there that are up and to the right at a 45-degree angle like that. You had healthcare was left for dead. Some of it still is. Healthcare is doing well. Healthcare is a sector that has gotten its mojo. There is M&A going on in biotech. And you can enter a situation where you feel like the tape is bearish. You feel like the vibes are bearish because maybe you yourself are heavy in Korean equities, which have rolled over and died really in the last 30 days. Or you are in Mag 7 type concepts or what have you, and you feel like it's a tough market. But where's the S&P? 75?
Yeah.
What's the high on the S&P? 75.
75. We're right at the top.
So there's nothing has happened.
These aren't the dark days. Well, how does that happen? Because I've been so many times in my career we've heard about the unloved bear market, the unloved bull market. It's a bull market, and everyone's just so unhappy.
Yeah, well, why is everyone so unhappy? I mean, we could do 2 or 3 hours on that. I mean, the concept of the K-shaped economy. We have, across the US and Canada, people have to pay higher gasoline price. And I also think, there's a very real phenomenon of you open up Instagram, you open up whatever social media you prefer, you see somebody you know from high school and they're on vacation in France and you say, everybody has it good except for me. And you think, well, not everybody's on vacation in France. They're just showing you that part. They don't show you when they're doing the dishes in their underpants, right? Like we all do. Well, I don't know. Are you doing it in your underpants?
Occasionally,
Bring up the photo. Bring up the photo
Get
here.
the photo. And so that's, you had, I want to say, was it a day or two ago, U.S. consumer confidence printed. And once again, just another punk number on that. And
Like Wall Street versus Main Street, basically.
Yeah.
Wall Street versus Main Street. I mean, if you have a retirement plan, you've made a fortune in that if you've been saving for retirement. If you have a brokerage account that you frequently check, you're seeing green ink as the months and quarters roll on. And if you don't, all you see is you go to the grocery store and the prices keep going up and maybe your wage has stagnated. And so that's what's absolutely critical is people are in these silos of their own friends, right? You're upper middle class, your friends are upper middle class. You're in the lower class, your friends are in the lower class. And so you can't see across the various income strata. And then you end up having a bunch of very wealthy Wall Street people wondering why consumer confidence is down. I think that they get it, but I don't think that a lot of them are living it.
Yeah.
So let's talk about then, consumer confidence. One of the things when we look at the M2 money supply, and obviously let's look at the US dollar. That's obviously been making highs as well. I think we're 101 on the Dixie, 101.6.
Okay.
Highest level since June. We've got, on the backstop of that, you've got 3 Fed officials that were dissenters yesterday at the FOMC. So how big of a swing factor is the dollar's next move going to be, especially now, are we going to get another salvo of tariffs coming out again with the renewals? What's the back half of the year going to look like with the dollar this high and new tariffs imminent?
Yeah, and it depends on the pair. I mean, against the Canadian dollar, I mean, things are pretty, you certainly notice it. I'm an American guy, we're in Toronto right now. You can notice that the price differentials, it's readily apparent. But you have, for example, the Japanese yen, the question marks on that. That hasn't really been such a pain point on the tariff side. The recent one from about a week ago, the 10 up to 12.5%, whereas the Canadians got this threat of 50%. Right, and so that's going to be a big question mark for both the U.S. and Canadian economies is how does that get settled, because that's a rolling saga. But a lot of it stems to what the various central banks are going to do if you're trying to figure out the dollar. I think the Bank of Canada is also throwing its hands in the air and saying, I'm not really sure what I'm going to do next. The Canadian economy looked 90 days ago, it looked like it was in a recession. You had those GDP prints that were red. Everybody was talking about it. The other day, the Bank of Canada was essentially saying, I think their figure is 2.5% is their estimate for GDP, real GDP in this country in calendar 2026.
Now we're talking growth again instead of
2.5.
That's really good.
That's really good for a G7 economy,
Yeah.
2.5-ish. And so does the BOC have to end up hiking at the back part of this year? Maybe that saves the loonie a little bit at the expense of the economy. If you're thinking about other pairs, I mean, Wisdom Tree has always been big on Japanese equities. Where's the yen going due to the currency hedging business? It almost looked like they intervened last night because it went from 163 to 161, but I think it was just reaction to Kevin Warsh going, basically not acting. But that's another one where do you end up with a situation where the Bank of Japan goes from 1 to 1.25? Maybe this week. I don't think so. But I think traders and investors should keep an eye on that because that is a major economy that could be theoretically tightening very, very soon into a situation where the Japanese bond market has an upset stomach. And it goes back to what we were just talking about earlier when we opened the show at 460, 470, whatever it is on a US 10-year T-note, that would be something that could be an obstacle for equities. So you think you're sitting in Ottawa, you're sitting in Montreal, you're sitting in Vancouver, you think, oh, well, what do I care about what's going on in Japan? Well, there's big money out there. And if they tighten policy, what does that mean for, let's say, cyclicals? What does that mean for cost of capital and these various concepts?
Let's bring it all back to portfolio positioning. How are you thinking about this market? It's been a volatile 24 hours. I mean, it's been a volatile year.
Yeah.
Has it changed your mind about where, capital should be deployed?
Well, I mean, there are some areas that I think are in pretty good health. As I mentioned earlier, the financials look pretty good. I have reason to believe the regional banks could get some mojo if we can stabilize the bond market. And I don't even think that we were talking about an instability in the bond market. It's just a bond market that's selling off. Healthcare looks fine. I've been tweeting a lot about the situation with strategic reserves on the oil side. There's been a massive drain, for example, down in the U.S. The point I oftentimes have been making in recent weeks is in reaction to the Russia-Ukraine initial invasion, the U.S. drained by 250 million barrels, the Strategic Petroleum Reserve. That was off of a base that was up here, though.
Yeah, the tanks were full back then.
Tanks were full.
Yeah.
Tanks were full, and so you're partially emptying the tanks, 250 million barrels, but over 16 months. And then this has been 108 million barrals over 4
Yeah, we
months.
see it. We got
where
your
the trend's
graphic up on
going
the
now.
screen. And it's just like you can just take a look at
Pulling
it.
it down.
There.
It's been quick. Now look, the society is not as energy intensive as it once was. I will oftentimes point out, Greg, look, if it's 1979 and you have an Iranian revolution and it's now time for you to fill up your household tank, what are you getting, like 12 miles to the gallon?
And the tanks were big back then.
The car was
Those cars were boats.
And now, I mean, you don't even forget EVs and hybrids. Just a regular traditional combustion engine. What are you getting? 30 or 35 miles to the gallon. And so these stocks at the consumer level, at the risk of saying the crude oil price is only unleaded gasoline, as if it's not manifesting in, the manufacture of this coffee mug, We're not as energy intensive, so it shouldn't be as bad of a shock as it could have been. But the reality is it seems to me it's 2 days on, 2 days off in Hormuz. Before we went on air, we were pointing out the Egyptians are reporting that they had a couple of fires very near some sort of energy hub. That's yet another country
They're getting drawn
It's
in.
in the
that's in
crosshairs now.
this.
Yeah.
And we think, and I say we, I extrapolate to you two guys, we think it's Israel, the United States, and Iran. Well, it's actually like 10 of them, or 12 of them that have had some sort of receiving end of an attack or giving end of an attack in that region. And I don't know that it's fully appreciated in the comfort of North America.
Yeah.
Jeff, we've had a great conversation, and obviously we've had a lot of data that's come out turning into August. We've got the CPI print that's going to come out. We've got also the Jackson Hole meeting that's going to happen, the symposium, of course. So, and the hotly debated September Fed decision. So, with everything on the list, what's the one sort of market signal that you'll be watching most closely over the next few weeks to just get a pulse on how we shape into the end of the year here?
Well, you want to see that you have manufacturing and services PMIs behaving. That's a gauge I like to look at to see whether or not we have an economy that's healthy. But you almost want it to be in that middle ground, because you start getting a little hot.
Not too hot, not too cold.
Yeah, just in between where it's sitting at right now.
Yeah, because what you don't want is a 4 handle on Fed funds anytime soon. And then you start doing that, then you're going to, boom, now you're prompting the Bank of Canada to follow, right, because of the loonie. The BOJ would then have an easier impetus to get from 1 to 1.25, and then now suddenly you have globally coordinated monetary tightening. So you want something like, dare I say, the cliche of the Goldilocks on some of these economic prints, and so we'll see. The other thing that I would point out as people follow inflation prints in the coming months, specifically U.S. CPI, which, look, they look at the PCE, but they're also human beings that have reputations. They're looking at CPI too, let's be honest. And CPI in the United States has about 26% of the thrust of it is from owner's equivalent rent. And the reality is that home prices in the United States are absolutely flat and doing nothing. So it's artificially showing inflation on that front because it's doing the catch up from the COVID data when home prices went vertical. Like, somebody's house on the Carolina coast, Scottsdale, that stuff went vertical. It's now playing catch up on that. So when we say, what did we say, 3.5 on a CPI, it's probably some number a little bit lower, but tell it to the judge.
Yeah. Jeff, real pleasure to have you here in the studio. Really enjoyed the conversation. Hopefully you visit us more often.
All right, we'll do it again.
We'll do it again for sure. Jeff Weniger is head of equity strategy at Wisdom Tree. And just a reminder to our viewers that the strategies and securities discussed on the show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Now, you at home have a question for our guest or our team. It's really easy to get in touch with us. Just email us at td.activetraderlive@td.com. And for more information about the ActiveTrader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD ActiveTrader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on the Try TD ActiveTrader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Now it's time for Technical Take, and the stock in the spotlight today is Apple. If I said, quick, describe the company in one word, you'd probably say iPhone. And I wouldn't blame you. The device remains Apple's economic engine, accounts for roughly half of its revenue. But in an era when investors are focused on artificial intelligence and fast-growing services businesses, can Apple prove it's more than just an iPhone story? For more on Apple ahead of tonight's earnings, what the charts are telling us, here's Hiran. What are we seeing in Apple?
Yeah, Greg, you pointed it absolutely correctly. So obviously iPhone's still driving the bulk of that revenue, but the services business is driving the profitability, and that's a key one there. They're also trying to rapidly ramp up the AI, Siri partnership with Gemini into its product suite as well. So this Q2, or this will be the Q3 earnings print that will be released after the close today. It'll also be Tim Cook's last, presumably, because he's going to be handing over the reins to John Turnus in September as the CEO. So the expectations heading into this one is an EPS of $1.89. That is going to mark 20% year-over-year growth, $109 billion on revenue side of things. That's roughly about 15%, so still double digits on both of the top and bottom line. Now, Apple comes into this with a strong record. They've 8 consecutive beats in the previous quarters. iPhone is the primary growth engine here, expecting about 53 to 55 billion of that contribution coming from the iPhones. But interestingly, what's happened is they've also gone through rate hike cycles, but they have spared the Mac and iPhones from doing that, but it has gone because of the memory cost that we're going to hear. So that's going to be interesting for us to see. One, first is, what is the memory cost going to be? How many expectations on the price hikes do they expect? They also recently partnered with Klarna. They're now going to be leasing their product suite.
I saw that, leasing iPhones.
Leasing iPhones, leasing MacBooks, and all of their things. So we'll see how much of that business, it's supposedly in the services segment, how much that's going to generate for them. So that's kind of the key things I'm watching into this earnings print is their AI Apple monetization that they have. Signs they're integrating more of that into the product mix, and then also the gross margin and China trends that we've seen. We've seen memory cost add margin pressure to it, but demand in China remains critical as a driver of sentiment for the stock. So, looking at the charts, Greg, it's in a classic textbook bull structure that we have over here. Up and to the right is what it is. I want to say close to 45 degrees. We've had a little bit of a pullback, but it's a healthy one that we've seen. We can see coming out at the start of 26, it was kind of in this range-bound area, vacillating between this 245 to 280. We did finally get a breakout. This was a sort of double bottom that had formed. We saw this big breakout. It sort of tested this, so we know it's a very valid level at 280 once you can do the breakout and retest here. In doing so, as we zoom into today's kind of price action, we did also form a bull flag. So we saw the steep run up. We sort of went sort of sideways down, and then we broke out of this channel, and we just topped towards close to the all-time high at this 343 level. It tagged it. We did see a bit of an inverted hammer forming at the top of this candle, which is a bearish reversal that does pattern to us. And today the stock did gap down. So heading into this earnings print, though, expected move based on the options pricing for options this week is about $12 move. So either if it comes out and it's all glory, then we could hit the 355, cracking the 343, possibly retest down to the 330. We are also in price discovery. So there's just one more thing that I just wanted to show our viewers is we wanted to show the Fibonacci extensions. And what this allows us to do, it tells us a previous move up that went when we saw the retracement, what that could possibly forebode to the next move. And based on the extensions, I should say rather, we're possibly looking at breaking past that 345. If we do the golden ratio inverted, that possibly tests out the 390 on a best case scenario there.
All right, some very interesting chart work there. Now you're going to walk us through a couple ways to trade Apple. Before you get started on that, though, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where are you going to start? Bearable.
We're going to start with the bull case on this one, Greg. So let's talk about this trade over here. So if you are considering to be bullish, especially with the setup that we've had so far on the charts, one of the strategies you could consider doing is what we call a call back spread, or you want to call it a back ratio call spread, whichever one term you want to use. So essentially, what the idea with this trade is, it's comprised of 3 option legs in a ratio. So we're looking to buy 2 355 calls. We're going out to the 28th August cycle. That gives us roughly about just over 30 days there. And we're looking to sell a in the money 335 call. Now, when I did set up this trade after the close yesterday, Apple obviously was trading a bit higher, so this call would have been out of the money at the time. It's obviously gapped down today at 331, but the idea is we want to sell a little bit out of the money. So the way this trade works is one of two ways. Because we're buying the 2 and we're selling an in-the-money call, we actually get a lot of credit. So overall, this trade results in getting a net credit of about $3.90. So we're collecting essentially this one short 335 is paying for the long duration that we're looking at, or the long speculation here. Now, the way the trade works is because we've got a net credit, when we think about our break-evens or the best case scenario, and maybe I'll do the reveal, it's just kind of teasing you there. So let's roll it up over here. It is unlimited in textbook, but we're not about theory. Let's just say it's a lot. Yeah. And the reason that works is if Apple does push up past the 355, that's a best case scenario. Depending where it lands up by the time August rolls around with our expiry, that's where we stand to gain the money, plus the credit we kept that we made with it. The downside to the story, though, however, is if it does stay in this zone right here, I've just marked it in this red, this is the worst case scenario. If it's just stuck in that 335 to 355, then that's no bueno for us. That means we will be out the spread, so that's $20 between these two strikes. We did collect some $4, so we do end up losing about roughly $16.10 on this trade if it lands up there. If it actually falls below 335, that's not a worst case scenario because the call would be out of the money. We still get to keep the $4. So this is where the danger zone is going to be for us.
All right, a very interesting way to play it from a bullish side. What about the bearish side?
So with the bearish one, I did my charts did a bit of a Houdini on me. So I'm going to go into we're going to go into the options chain and show you. Yeah, we're going to go into the options chain and show you what this trade could be. We're still playing on that ratio theme over here. So if we go out to the 30th August cycle here, so we want to go roughly 28 August here. This trade is going to be what we call a front ratio put spread, I should say. So what we're looking to do in this case is we're looking to buy, speculate to the downside. So we already saw Apple gap down. Yesterday was at 342, 343 and change when it closed. Today it did gap down. So ideally what you'd want to do is to look at the time I had just selected a strike slightly out of the money, the 340. So we're looking to buy one contract on the 340, and then we're looking to sell. And I'll just set it up and you can see on the order entry. So there's our 340 selected over here. And then we've also got, and we'll just adjust the strike to 1 over here. We'll unlock it. We're going to sell 2 of the 320 puts over here. Now again, the idea is it's helping us pay for that 340 put that we bought. When I set up this trade, it essentially was a debit trade. It would have, you can see right now, I think when I set it up, it was costing about $250. It's ticked up a bit because the stock's gone down. So the idea is you're doing basically a bear put spread. So you're speculating to have the stock go down to 320, but then I turn bullish because at 320 I'm thinking there's enough of demand coming in where they're going to bid up the stock again. So that's the whole idea. So we want the stock to come down from 340 down to 320, and if I'm using the 250 as my sort of number cost, the way I would make the profit is I would simply take that and subtract the width of the spread, which is $20 minus the 250, which works out to $17.50 in this case. And then that's where our profit is, but where our loss is going to be, of course, is if the stock either buoys up to past 340, then we'll be out the 250 cost that we paid, or if it breaks below 320, then we get in a bit of trouble because yes, you did make profit, but you also have one option because we're doing a ratio that's uncovered. That means you're gonna have to pick up 100 shares of Apple at $320 a piece. So in theory, the way you could lose that is you just minus out the 320 going down to 0, add the 250 you've had. So in theory, we could lose $322.50. A lot, in other words.
All right, they can take away the man's charts, but they cannot take away his strategies. You danced through that one brilliantly again. That's it for the show this week. As always, investors should perform their own due diligence before engaging in trading. We're actually going to take a short summer break, figure out what's going on with Hiran's computer, a few other things. We're going to be back after the September long weekend, though. Thanks for watching.
Good old housekeeping that we've got going on.
Just get you.